This guy owns 262,000 shares of CLOV at an average price of $2.56, and he's been holding it for over 2 years. That's a nice little $670,000 investment he has going on, but now that CLOV is sitting at 91 cents, that's a bit of a painful place to be. His $670,000 is now $238,000, meaning he's been sitting at a roughly $432,000 loss. But it's not a loss if you don't sell, right? Right? Anyways, this video isn't meant to bash on our boy here. It's meant to shine some light on his very important question: selling covered calls. If you're not familiar with options, give me a few minutes to explain. If you're already familiar with options, feel free to skip to the next section of this video. And if you're skipping to the next section of this video, you might as well scroll down and hit that like button since you're already down there. All right, options. We have calls, we have puts. If you buy a call, you are bullish and you're thinking that the stock is going to go up. If you buy a put, you're bearish and you think the stock is going to go down. However, it's the opposite when you're selling options. If you're selling a call, you are bearish and you think that the stock is going to go down. And if you sell a put, you're bullish and you think the stock is going to go up. These are contracts. You can buy a contract or you can sell a contract. Each contract has a price associated to it. That's called the premium, and each contract represents 100 shares. Each contract also has a strike price and an expiration date. The strike price is the price that you think the stock is going to be at that specific expiration date. It's a bit of a guessing game, but it's a very powerful tool when used correctly. And I want to take a moment to show you a real options chart right now so we can talk about what it all looks like. So here we have Tesla's option chain. You'll see all of the strike dates, the expiration dates. Here we have Tesla's option chair. You'll see all of the expiration dates. And if we just go ahead and click on one of the expiration dates, it'll show us all of the strike prices, all of the possible stock prices that we can guess on here. Over here, you'll see the bid and the ask for that specific option. Right now, Tesla's trading at $201. So if you think Tesla is going to be $205 by November 17th, you can go ahead and buy this option, this call option. However, it's going to cost you $7.95. But remember, each contract is representative of 100 shares. So you multiply this by 100, it's going to cost you $795. And once you buy that, you are then the owner of this contract and you have the right to buy Tesla at $205 per share by November 17th. The best case scenario for you is if Tesla stock skyrockets past 205, let's say it goes to 210, but you have the right to buy it at 205. However, your options contract value, the premium, will also go up if the stock price goes up. So instead of $790, it might be worth $800, $900, $1,000. As you can see here, the 195 contract is $1,300. So the more the likelihood of a stock being in the money or below what the current price is, the higher that option cost, the higher the premium of that option. So let's say that you own 100 shares of Tesla. You can actually come in here and you can sell a call. And if you sell a call, you are saying, I don't think Tesla's going to be 205 by November 17th. And somebody would pay you that $790 instead of you having to pay that $790. Now over here, he had a question about selling covered calls on CLOV. He says that he's never traded options in his life, but he's really interested in learning about selling covered calls. And remember, he has 262,000 shares. His first question was, can you sell covered calls with a cash account or does it have to be with a margin account? Well, you can sell covered calls on any account that has options enabled on it. It doesn't have to be a margin account since you already own those shares. And since each contract represents 100 shares, you are selling a covered call, and the covered part means that you own those 100 shares and you're covering the call that you're selling. His second question was that he wants to sell a call. Does the strike price have to be more than the current average price that he's bought them at, which is $2.56. Now this question is kind of up to you. You don't have to, but there are best practices when it comes to this stuff, so you should be careful. You could totally sell a covered call under your average price, but if that stock price goes up above your average price and you're forced to sell it at the strike price that's under your average price, you're going to lose some money here because you're going to be forced to sell 100 shares under the average price that you have. The best practice is to sell contracts above your cost basis, but that's not always possible. Sometimes those contracts just don't exist. Sometimes those contracts aren't really worth much to begin with. His third question was, can you sell more than one contract at a time? Yes, you can, because you have 260,000 shares, which means you can sell 2,620 contracts. However, it might be hard to get a order fulfilled with that many contracts. The next question you should have asked is, when is a good time to sell a call? Because typically you want to sell a call when the stock is going up, and it's going up violently. With more velocity, the faster it's going up, the more bullish everyone is, the more volume, the higher the likelihood that the stock is going to keep that momentum, and the higher the implied volatility of that contract means the premium of that contract is going to go up. The value is going to go up. So you can get more dollars per contract sold. Let's hop into CLOV's contract chain real quick. Let's pretend like we're going to sell a December 15th call, and the only options that exist right now are the 50 cent, $1, $1.50, and $2. You don't really have an option more than your cost basis. Maybe if we go to February 2024, then you got $2.50 here, but the bid and the ask are 1 cent and 10 cents. It's a very wide spread. There's not much volume, if at all, on any of these. We go to January 16th, 2026. That's when we can start seeing some more contracts. But even then, there aren't much buyer. Even taking a look at today's option statistics, only 1,680 calls were being bought and 49 put. Overall, people do seem to be bullish on this. However, with volume going down and with the stock price being at where it's at and with earnings coming up, the best bet is to probably just continue to accumulate and lower your cost basis if you want to continue your investment in this stock. None of this is financial advice. This is all just educational for you to just get an understanding of the tools you have available in your tool belt. Hope you guys learned something. Be careful, keep it small, keep it slow, paper trade. Good luck, and with that, I'll see you in the next video.